Hello everyone, myself Somenath Chatterjee. I am a program associate with Amity Amity Future Academy. We will be today discussing about portfolio risk management and early warning signals powered by AI and ML. So this is a very important topic in today's context. So before I start the topic, let me just talk about it that how portfolio risk management is important. In the banking space and the lending space, we have been seeing in the last, at least in the last 1.5 years, there have been a lot of issues with the NPAs coming up. Okay, there have been issues in terms of collection. These are partly due to COVID, and prior to that also there were some issues, some stress across. So the regulator are saying, insisting that there should be early warning signals. So the portfolio needs to be continuously monitored with the help of AI algorithm, artificial intelligence based algorithm. You have to make an algorithm such that you can get an early warning signal. So basically, from a reactive portfolio management, you move to a proactive. What do I mean by that? That is that earlier when there was a collection or when the EMI were due, it could be a personal individual loan, it could be a corporate loan, it could be a SME loan, anything. So when the particular installment was due, whether the risk or the principal amount was due, unless the amount is due date is over, you're not able to know whether there will be a chance of default or not. Obviously, there are behavioral indicators about the industry and others, but in context, if it is not under time you reach the presentation of the check date or the EMI date, you're not able to book or know anything about the account. But with this kind of algorithm, early warning signals, we can in advance we can come to know whether there will be some behavior, abnormal behavior in the particular portfolio or the particular account, and which can lead to a NPA. So this trend. The early warning signals have been developed, and still it is evolving. And in India, yes, it is quite prevalent. And as I said, that there's a lot of pressure from the regulator side that the lenders, the banks, NBFCs, microfinance, they should be using this. So portfolio risk management in today's context is topmost priority, and more so because we have been facing a series of lockdowns, series of muted businesses for the last 1.5 years, and still there is a lot of uncertainty. So in that context, portfolio risk management becomes something of immense important. So we will go through this, how it happens, and then we will be able to connect. What is the portfolio risk management? The portfolio is run through algorithm on a regular basis. There's an algorithm which is built, which is a basically artificial intelligence based algorithm. And how the AI bit is basically taking off past data, do a machine learning on that, and creating an algorithm. It is done on R, it is done on Python. There are various packages, program where it can be done, but it is mainly dependent on the past data. So how the model can be robust if the data set is very high, if the data set is perfect, that means the proper data set. The challenges here comes is to develop an algorithm is the data set. So data set is very important in this. So with that data set, data is washed, data is checked, data is validated, and an algorithm is created with the help of machine learning. The system throws early warning signals. So basically, as I say, we move from a reactive portfolio management to a proactive portfolio management. So a business head knows that I am supposed to get 100 rupees this month. So normally they look at a 2.5, 3, whatever percentage of NPA, depending on the geography, depending on the portfolio, and depending on the product. The business head knows that how much money is going to come back. So in this 100, if we know that 2% is an approximate, so 98 will come back. But here if this so accurately can be done, there that you will know exactly how much of money is not going to come back. That is one. Number two, the important thing is that when you proactively know that this amount might go bad or this loan might go bad, can actually connect with the particular consumer or the customer and discuss about the particular portfolio. So that helps in the proactive management, not only having a knowledge, also connecting the customer, and more so if there are large loans, if there are SME loans, SME small and medium term enterprises, the lender can sit with the particular company and see how can be helped. This helps in NPA management in a proactive way. As I said, we move from reactive to a proactive management. We know what is going to happen. The entire model is based on prediction analysis or predictive analysis. So what is predictive analysis? Predictive analysis is used by way of the statistical method regression. And as I said, we get the data, we wash the data, the descriptive and inferential statistical analysis is done. So fintech is basically finance plus technology. So finance part will come with the historical data, future prediction, and what is the business problem and how to solve the problem. The solution of the problem will come from the tech part of it, where it will be a statistical tool, which is the regression part of it. The data will be taken, regressed, and then you'll start getting. So it's a simple regression, and obviously if the data sets are huge, if there's a huge amount of data, then obviously it becomes more and more and more complex. And then with the help of a coder, the coding is done, machine learning and AI is developed. This algorithm, this machine become smarter and intelligent when more and more data set is run through it. So when you initially make an algorithm, probably it will give based on the accuracy of the past data, it might give a 95% or 96% confidence level. But as monthly, every month, or even if a daily basis or weekly basis, more data is run through it, it will become more and more intelligent. That means it will become more and more accurate. Obviously, the prediction cannot be 100% confidence level, but it can take up to 99.5% prediction level. So that is what the strength of the algorithm will become. So just to give what I have mentioned, basically the potential threat in the banking system, increasing bad loan and NPA. Banks are currently struggling with ever increasing amount of bad loans and NPA. Increase in gross NPA. Banks are currently struggling with ever increasing amount of bad loans and NPA. Lockdown implications. Lockdown has impacted the debt serving capacity of Indian borrowers. So as we mentioned earlier, also we have discussed that prior to COVID also there were some stress on some of the portfolio, but more so in the last 1.5 years we have seen series of lockdown in various geographies, not only in India and across, and still also there are a lot of movement restrictions there, which is impacting the business. So this impacting the business is actually putting a threat on the repayment capability of the business. There are many kind of business which has been impacted very highly. Thereby, if you look at the banks are raising a huge amount of capital. They have raised last year, they are raising this year, and even the NBFCs are trying to get capitalized because the NPA percentage will increase, and it's increasing because we have seen last year there was some moratorium given, and this year probably we will see the amount of the bad debts or amount of NPA percentage will rise compared to the previous year. So what to be done in this context? This early warning signal will help, which is a part of the risk management. It will help basically tackle the NPA problem very proactive way, and at least controlling the NPA or the bad debt problem. Not only it's about the current times, but even in future, this kind of technology will help the businesses to plan in a better way. It shows as a lender, what is the lender doing, whether it's an NBFC, whether it's a bank. It gives money to client and the money comes back. So it will give a very predictive or very actualistic thing that when my money is going to come back. So that is the advantage of this entire system. Early warning signal the way out. An early warning signal acts as a preventive measure to protect the lenders from the risk of non-compliance on the part of borrowers. It takes the form of a proactive measure rather than a reactive approach, which is currently being followed. As I said, that currently is a reactive. So on the 30th of the month, we know this amount is going to come back. If it doesn't come, then there's immediately an alarm is put in the system, and trigger is there, and then the bank official or the collection team, whoever, starts following with the particular customer, whether it's a SME customer, corporate loan, or an individual. But here we are talking about proactive. That proactively you'll know that this is going to go bad, and we start talking to the customer. With the help of data analytics, it is possible to estimate the financial stability of potential borrowers and approximate when the borrowers are going to default. So data analytics has actually changed the way, at least in the last 2-3 years. The kind of MIS, the management information system, which were generated within the companies, within the businesses, has changed dramatically. Now, data. So the earlier what we used to call the MIS has evolved as data analytics, and data analytics powered by AI gives you strong indication of the business, strong indication of the performance of the team, strong indication of the performance of portfolio. So data analytics is equally important in this. And with the help of data analytics, it's easy or it is possible to estimate the financial stability of the potential borrower and approximate when it's going to default, or will there be a stress in the particular account, or will there be a stress in the particular portfolio. Requirement for adopting EWS, early warning signals, basically know your customers, how it is imperative to have a comprehensive knowledge about your customer. Information should not be limited to those asked in the application form, but various sources should be combined, like credit bureau, macro factors, etc. So what we are trying to say in this is basically that it's not only about to know the customer in terms of the financial data points. We are saying there are also alternate data points. We'll talk about these financial data points and the alternate data points as we move ahead in the presentation. But you need to make the system very robust and make the system very foolproof. The more data points are taken, it becomes advantageous. So, for example, earlier when a loan was given, there were certain data points were taken. So there could be, those are largely financial data points, and those financial data points could be 7, 8, 9, whatever, or maximum of 15, which includes your salary, bank statement, tax report, other things, or if it's an individual, then individual various points. But now with the alternate data points, there is something called behavioral data points, which we will discuss as we move forward. It can go up to 200, 300, 400. You can take as many numbers. The more the number of data points you will take, more the system becomes robust, and it takes care of all the kind of hedges all the kind of risk which is there in the system. Thereby, you have to know your customer, and know your customer is not only in the spirit of the form, is also in the spirit that the other data to be taken. That's why it's mentioned that information should not be linked to those asked in the application form, but various sources should be combined, like credit bureau, macro factors, etc. Etc. means you are talking about all the behavior or alternate data points. We'll be talking about it as we move forward. Increased interaction with the customer. A relevant and supportive communication is important. A proper follow-up sequence must be initiated with borrowers at different level of default risk, and necessary action must be taken to match the given circumstances. So not only you need to know your customer, you need to continuously be in touch with your customer and understand when the repayment is there, to understand what is the behavior in the industry the particular customer belongs to. If he's a salaried employee, then what is his industry is giving a signals, or if it is a business or a self-employed person, then how is that particular business, particular geography, particular location doing. So increase the interaction and also just advancing it. This is what the basic requirement for the EWS. But what are benefits of early warning signals? We mentioned earlier also that it will lower the collection workload of bank by including early intervention and prevention of a scenario of default. So as the collection team today, largely the collection team or the portfolio management team will do a reactive way when they see there's a bounce in the EMI, or there's a check bounce, or there's an amount default. They will go and meet the customer, and there are various processes from 30 days to 60 days to 90 days. Various regulation are there, and accordingly the customers are discussed with. So if there's a proactive, it will reduce the collection workload. Not only collection workload, rather we will say it will also increase the productivity. The work which earlier was done was it's a kind of post-mortem. Now it will be proactive. At the same time, the productivity will high. We can see a less amount of loans going bad. In any kind of typical portfolio, it cannot be 0% default. and it doesn't happen, doesn't happen, then 100% amount comes back at least in the retail side of it. But here, if you can introduce the system, the early warning signal, it will at least make the collection or the risk management, portfolio risk management department work more smarter in a productive way. Protection of revenue stream. While building strong relation with the borrower, your revenue stream will be protected and your relation with the customer will improve. It will help in customer satisfaction and customer delight. Securing payments before the risk of clients turning into NPA. Obviously, a large part of money will get prevented from moving into NPA. That will be help. A feasible solution in terms of time, money, and effort. So it's a very feasible solution in terms of time, money, and effort. Timely identification of risk worthiness of credit seekers, which includes the decision-making process. So very timely, you will understand, identify the risk worthiness of the credit seeker, which can influence the decision process. Building of early warning signals. Begin with creating a system of well-synchronized credit assessment tool that use data from a variety of sources. This will expose lender to multiple market-based and fundamental indicators that highlight the possibility of potential default. Once you have a system of early warning signal in place, feed it with accurate data. The internal data is an accumulation of borrower's history and profile. The data should be updated regularly. So this what I have been saying, that more the number of data is passed through the algorithm will become more and more intelligent. It will become more and more strong and robust. To develop an early warning system that diminishing the risk for lenders, there is also a need to leverage third-party research from buying and sell-side analysts. How to fortify early warning signals? Strong collaboration between a banking process, technologies being leveraged, and loan assessment officer. So what do you mean by strong collaboration banking process technology? So largely these kind of technologies are built by fintech companies. So fintech companies are the strong sources for the technology. They have their internal data scientist team and they prepare this algorithm. The banks collaborate with the fintech company. So it's a complement to they work in complement rather than separate. So fintech companies, when they devise this algorithm, they sell or hire or lease it to the bank uses them, and accordingly the system is formed. Now it is not largely it is outsourced by the banks and the NBFCs. Work out an in-depth and accurate data repository after a strict data selection process. So in-depth and accurate data repository to be worked out, and after the strict data selection process. Data selection of the data and getting the data is extremely important. As I said earlier also, getting the right data. And there are various statistical methods are there, various checks and balances are there. And in data modeling, in data analysis, there are various kind of statistical tools are there, which ensures that the data is not biased, it should be unbiased. What do I mean to say? That if you are creating an algorithm for a loan to be given all India, then the data on which the algorithm is created has to be unbiased in terms every geography should be in that at least represented. Otherwise, if you are taking only 3-4 states or few geography, what will happen? The other geography gets left out. Similarly, if you are doing in a particular city, the data has to be unbiased. The sampling has to be done from the population. At least the sampling should be very unbiased sampling. So these are the various statistical tools which are used on the data. But yes, if the data is wrong, then ultimately the entire algorithm will be challenged, and the result will not be correct. Many a times it has been seen that the data, which are proxy data, have been used, and when the algorithm is created, initially it has shown as a 98% confidence level, and when it has been actually put in the system of the lender or which is a bank or NBFC, it was showing 55 to 58% accuracy. That is because the data was not correct. So basic source of the early warning signal will become how strong is the data set. Pre-integrated efficient data corroboration mechanism. This is building of the algorithm. Sketch risk profile based on the borrower's profile. So do various kind of bucketing of risk. Depending on the particular lender, there should be sketching and bucketing of the various kind of risk profiles. You can put various profile under various subheads, subunits, or bucket. Deal with frauds and credit risk in a transparent manner. So that is that how you deal with the credit. So there should be a complete laid down policy, which is there with all the lenders, that what is the manner in the credit risk done. But in the portfolio risk management, the regulator is continuously saying that you have to improve the portfolio risk management, and that also use as far as that you have to use the technology, advanced technology. And this technology, the early warning signal, is a large part of it. So technology will give you an indication whether your loan is going to go bad or not. So that's what. So when you are making a process or making a manual for the fraud and the credit risk, it has to be properly documented. It has to be properly presented, and it has to be systemized. And technology is the key thing which has to be used in this. Early warning signal indicators. The use of AI, artificial intelligence, can enable early warning signals to mine early warning signal from its data. The early warning indicators of problem loans span financial behavior, geographic, and industry categories. So what these are it goes across geography. So for example, you have given loan across the country. Now there's a particular geography which is showing some tension in terms of some security issue or some lockdown issue or some other issue. Immediately it'll pop up in the portfolio that this particular portfolio belonging to this city will be showing some stress. Okay, so for example, as some natural calamity hits a particular, there's a flood, there's a huge monsoon, so it impacts for say 7 days, 10 days, it gets impacted. Now these all things will come up. It will show get red flagged in the portfolio analysis. So similarly, some industry is going through some trouble, so it will definitely again come up with the portfolio. Financial indicators. Financial indicators are among the most reliable ways to find out any asset-related issues and detect red flags pertaining to financial discrepancy and gaps. Common data points in financial indicators. So what we have been talking about, that there will be financial data points and there will be alternate data points. Financial data points or the financial indicators are basically the normal, which is the customer gives the financial transaction details from where you can know the financial health of the particular individual or the company. So financial indicators are among the most reliable ways to find out any asset related issue, because these are documented paper which shows the historical credit risk or the credit worthiness of the particular customer or the company. And it detects the red flag pertaining to financial discrepancy and gap. Obviously, it will show red flags. Common data points in the financial indicators that an early warning signal reads to detect stress will include customer credit worthiness, which is basically customer, does he have a credit worthiness? What is his score coming to? How much is his total income and how much EMI is already paying? So the very important thing is that what is the current obligation? Somebody has a 100 rupee earning. If the current obligation is crossing 40 or 50, then it's very difficult to add more loan. So customer credit worthiness, and it's for both for the corporate and the individual. Normally it is seen what is the current obligation. The current obligation is high, then it will be difficult to give more loans. This is the normal lender's perspective. Operating loan utilization, how the loan is utilized in the operations of the particular company, or if it is the individual, how is using it. But largely it is for the corporate, that how the loan is utilized. Expense management, how the expense of the company is managed. Is it that these are again, it will company wide, not individual. Expense management becomes important because it shows the cost efficiency of the company. Cash flow requirement. What is the cash flow requirement? What is the working capital requirement is there? How much is the requirement, and are we giving more than that or less than that? Covenants and collateral tracking, collateral which has been given, and other promoters guarantee, other personal guarantee, tracking those. Account receivable and debtor aging. So account receivable is basically sundry debtors, that how many days you are supposed to get the money from the customer. So account receivable and data aging at least becomes important because it shows the number of days your debt is due. So debt in terms of sundry debtors are due. So if the market talks about 30 days is the sundry debtors average payback. And if your company is giving about 90 days, then there's a problem. Then there's the selling policy. There's some stress in that, and there can be various. These are some of the points we have mentioned. It can be even sundry creditors, what is the policy, and various other things. Idea is that financial indicators give you an idea about the financial health of the particular company, how what is the stress level is there, how is the company operationally efficient, if there's a issue in the efficiency or not. Industry indicators. So industry indicators become very important because if you're giving a loan to an individual who belongs to a particular industry, you know. So for example, in this current time, there's a stress in travel and tourism. There's a stress in the hospitality, which is because of the lockdown. The travel movements are restricted. So if you have a loan portfolio where it is quite lopsided, or it is quite focused on the travel and tourism, hospitality, other sectors, then you have to immediately look at your portfolio, look at your customers and see that how the repayment will be tracked, or come out with a solution. So there's something called scheduling of loan, not postponing, but there's rescheduling of loan. So should be done. Similarly with the corporate also. So if you have given a loan to these industries, your customers are there. You need to, as a lender, you have to sit with the particular industry, particular company, and discuss the repayment plan. So to minimize the risk on corporate loan, banks usually take into consideration the future growth of a customer business. For this, several industry indicators are measured and analyzed, such as industry growth rate, industry regulation, ability to control cost, rising import prices, emerging market trends, changing customer behavior, and also the technology part of it. Very important is so when we are saying that technology part of it, basically whether the technology will keep this business viable or not. It's a very important question today, asking after 5 years whether this business will be viable or not, whether this business can be done in a different way. And we have seen a lot of businesses doing work in a very different way. They have changed the way they have been doing, or a lot of business have been dismantled because of the technological disruption which is happening across. So by taking into consideration all of the above industry indicators, the early warning signal creates a forecast model that displays the statistics regarding the company's growth. So when you do a particular forecast of the company, the early warning signal will take care of all this kind of data points. So so that's why I'm saying it will be a robust equation when putting for a particular, and it will happen that it's not that it for all different product, it will be a different kind of algorithm. It's not that every product will have its same algorithm, because the logic changes. So for a personal loan product, the logic will be different. For an auto loan product, the logic will be different. For a mortgage, which is the home loan, the logic could be different. Also for you can keep the logic different in terms of geographies also, logic could be different. So it totally depends on the lenders or the user, how they want to plan it. So thereby, when you are making this early warning signal, it will consider into all this kind of industry indicators which is there: industry growth rate, industry regulation, ability to control cost, rising input prices, emerging market trend, changing customer behavior, and there are many more. Industry supply side risk, the entire supply chain will be looked at, and whether there's an international linkage in this, whether there's an international for example, if it's a metal company, if there's a linkage with the London Metal Exchange, and various things. So entire model will become so robust that will encapsulate everything in the industry indicator. Geographical indicators, we discussed about geographical indicators. Geographical contributes to corporate credit risk, include exchange rate devaluation, the yield in sovereign bonds, money laundering activities, country risk due to changes in the political environment, economic growth in the region. So geographical, like the exchange rate devaluation can be taken in the geographical indicators. It can also be taken in the industry also, if there's a forex element there, if there's an import or export is there. So exchange rate fluctuation, devaluation will be important. The yield in sovereign bond, the domestic yield, money laundering activities, country risk due to change in the political environment, and country risk comes again if you have an international business, economic growth in the region. And this geographical is not only that it will always be international, it can be domestic also. Domestic in terms of that you are running the business in certain part of the country, where they're prone to insurgency, they're prone to some riot, they are prone to some other things. For example, you have a certain set of customer in a particular city. You have 70% of the customer in that city goes into some natural calamity for about a month. So immediately it will throw up that there's a natural calamity, there's a flood, there's something else there. So the repayment will show a problem. Behavioral indicators. The behavioral indicators for corporate credit risk will include, now we are talking about the corporate credit risk, delayed financial reporting requirement. So if there's a delay in the financial report, that means basically the quarterly reports are delayed, or AGMs are delayed, or half-yearly reports are delayed. So that shows that there's a behavioral difficulty for the corporates. They are not sticking to the regulatory timeline. Deception, misrepresentation of facts. So there's a misrepresentation of facts are there. It's not coming in line with what is actually occurring. Lack of responses. That means questions are asked, but responses are not coming. Providing irrelevant information, the information which doesn't matches with the accuracy. Misrepresented or destroyed records. Records which have been, a lot of the historical records not kept. Lack of stakeholder interest in business strategy and planning. Stakeholder promoter interest is very less in the particular business. If there's no promoter interest, or promoter interest is reduced or minimal, then it actually takes a backseat. Too much changes in accounting personnel procedure. That's again a point for a banker would look at it, that too much change in the CFO, the frequent change of CFO, frequent changes in the accountant, frequent changes in the corporate strategy. It shows that there's a problem with the running of the organization. Creating fake or shell entities, creating companies which are like fake or shell or unnamed, kind of companies. So these are a few behavioral points which we are saying. It can be many. It can be many. This is only a few of the points. As I said, that list could go on and on and on and on. Alternate credit score, machine learning goes even deeper. Alternate data points. Now, behavioral data points is there, financial data points. In behavioral, we look at the alternate data points. Alternate data points are historical transaction data, historical transaction of the particular customer. Digital footprint. What is the digital footprint of the particular customer? The voice data. The voice data is very important. Now, there are many, there are some software which is like a lie detector. Like, what is that? So there's a software which has been developed where if you get a call from the software, and if you talk for 2 to 3 minutes, the software can give an indication whether the particular loan can go default, or it can be the loan can be good. Now this is, as I said, it's like a lie detector. So we get a call from call center where it always says that this call will be recorded for training and monitoring purposes. So in that also, with the technology part, the call can be recorded, run through that algorithm, and with that voice modulation or with the understanding of voice, it can be predicted whether the customer will be defaulting or not. Now, the logic of the algorithm will differ. There will be various logic in the algorithm, the voice modulation, the questions asked, the kind of reply, the way it reply is given. But it is again AI enabled, which can give. So that's why voice data is also a very important point in the behavioral indicator. Mobile data can throw your mobile. So, for example, a customer is in city A, but when he's been called by the lender, he's saying, no, I'm in city C. So why there's a difference? Why is it lying? And in the mobile data, the location can be tracked. So it is again one of the indicator. Telecom data, similar telecom data can be obtained. Location data, as I mentioned, mobile data similarly the location data. Utility bills gives you an idea about the expenses, how they are paid, are they paid on time, government databases, and this can go on and on and on. As I said, we can keep increasing the number, we can keep increasing the list, and it can keep going on and on. Financial data points, we have mentioned earlier, what are the financial data points? Bank statement, business information, GST data, credit bureau. Credit bureau is basically CIBIL score and other credit bureau score, and it can keep getting more because depending on the lender, what are the other financial statement they want. It can go for P&L, balance sheet, cash flow, projections, everything, the valuation of the company. But financial data points, the difference between financial data points and the alternate data points is that financial data point will be limited. It will be limited to the financial transaction of the company or the financial data points for the particular individual. It will be limited to that. But and it will be number, hard-coded number, which has been verified and audited. But alternate data points will be the behavioral indicators, which can be robust, and there can be any and anything. So for example, to give a perspective, that whenever the app we download an app. At today's date, everyone will have at least 8 to 10 apps downloaded on their mobile. The various popular app, at least during the lockdown, are the Swiggy, Zomato, where we can get food ordered. Apart from that, there are Ola, Uber, where it helps you getting a cab. And plus, there are other apps which we have a fancy or which is used by us. Now, when you download a banking app, the banking app, they will ask a permission that the app will read your SMSs, and this permission is given. So what happens when a permission is given to read the SMSs, except for the personal SMSs, which is from mobile to mobile, other SMSs are read. Personal SMSs are not read because this is a private and there's a security issue. So privacy normally is not breached. Only the other SMSs are read, like your credit card transaction, you get a receipt. These are read. So what it happens is SMS reading will give the fintech company or the technology provider or the person who is developing the technology. He will, once you get access to a person's 30 days or a month SMS, it can give, today's world, it will give a complete picture of the person. Most of the transactions are done digitally. When it is done digitally, either we do it for credit card or a debit card, immediately SMSs come. It can show the spending pattern of the person. It can show how is he and where is he spending, which items he is spending, where is he traveling. Everything will come. So there's a case when it was seen that there's a SME, there's a company where the entire thing was good. It has a very strong financial, but when this alternate data points were taken, behavioral data, it shows that the promoter is spending a lot more, and it will impact the business because promoter might take out cash from the business. So thereby the loan was declined. Why I give this example is that how technology is helping in improving. In earlier days, we would have just given the loan basis of the strong financial of the company, and probably a promoter, we could have looked at the promoter's financial. But now we are seeing we are going a step ahead and predicting the behavioral of the promoter, behavior of the owner of the business, and this can potentially give a risk. If you look at this early warning signals, how it is helping, for example, the maximum, there's a huge fraternity, SME companies, which I've been talking about, the small and medium term enterprises. Now, there are a lot of good SMEs who will have only 2 years historical data. While we know the business potential is very high, while we know the prospect is very high, but the loan is not able to be given or disbursed because the data is limited. So, somebody has taken a distributor of a large corporate. So it is known that every month he will get a certain amount of good and he'll be able to sell it. He has deep pockets, but the data points, financial data points are restricted to last 1 year because he's taken the distribution last 1 year. So what do you do in that case? We are not able to give. But if we have this technology, it will help. Early warning signal technology will help to give a lot of predictive modeling. Now everything is linked. So early warning signals, the technology comes at the time. Thereby, one of the slides I will show the loan disbursement also, how technology is used. So entire thing, while you disbursing the loan and managing the portfolio or the portfolio risk management, the entire technology will play a very important role. So what is the lender saying? Lender saying, I know the business models are good. Why don't we do a predictive analysis and look at its future and it has to be as live as every day. So what do you mean to say that when I log into the system on my early warning signal, every day this particular company is run through the algorithm, so that in a daily basis I know whether there's a risk or not. So thereby, as a lender, I'm taking a risk or I'm exposing myself with a limited financial data point. But since there's a technology involved, I have too many alternate data points about the business. And that is one. Secondly, I'm able to ring fence my portfolio by this early warning signal. That means a daily basis. So, but that's a daily basis is something which is still probably in pipeline. But at least once in a fortnight, yes, log into the system, it will be refreshed. It keeps refreshing once you log into the system. So, as a lender, if you the daily warning, at the end of the day, you get the portfolio MIS. It gives a lot of confidence to the lender to A, not to only lend more, B, to know that, see, my portfolio is very strong, and it helps building a better enterprise. So that's the way the technology is disrupting in early warning signals, and it's helping lenders to lend to unknown territory, unknown businesses. What do I mean by unknown businesses? Unknown businesses, again, what I say that with limited financial data points. If I require 5 years financial data points, at least with the help of technology, I can do it 2 years because I have alternate data points and it will help me predicting a better future. So this is one of the slides where we just wanted to show how collection is through technology and data science application, which is there. Repayment process is set up, then repayment tracking along with lenders, which is the integrated system facility. Automated communication, email, SMSs, WhatsApp. This is done by one of the fintech companies. So we have just taken that model here. And then loan portfolio analysis and repayment tracking dashboards. Then it gives the early warning signals. So initially, what we are doing in this? We are setting up the process after the loan amount is decided, the loan sanction is done, disbursement. Then we are setting up the repayment processes. Now this is for after disbursal. Okay. Then repayment tracking along with lenders. So this is a fintech company who's tracking the loan repayment along with the lender. Integrated system facilities. This is practically used actually. This is a use case which I'm showing. Automated communication, email, SMSs, WhatsApp, everything is exchanged with the particular borrower. Loan portfolio analysis and repayment tracking dashboards. So this is the dashboard which gives you the early warning signals. I will show one of my later slides will show what are the things we look at. But this tracking is done, as I said, it can be done in a quarter, it can be done in a fortnightly basis, it can be in a monthly basis, and this dashboard is made. So when you enter to the system, to the login to the system with the ID, you will see the red flag early warning signal. And then after early warning signal, there's a collection strategy, a hard collection effort, soft collection. Hard collection is where typical is a third-party tie-up agency for hard collection. And soft collection is offer settlement and other kind of discussion, credit repair, financial discipline counseling, debt consolidation. Extra focus to create a robust, proactive, and smart collection module. So I've been talking about this word robust and proactive. And I also say the machine will become smart and intelligent as more number of data moves through it. So this data becomes robust, proactive, and smart collection algorithm. Just again, taking the clue from there, the early warning signal based on AI and machine learning is the core of the collection module. So proactive risk management collection module. So what are the qualitative factors which are taken? Labor issues of the company, if there is any frequent plan changes. One of the slides we mentioned about frequent strategy changes, frequent changes of accounts people, frequent changes in the senior management, and frequent changes of the plan accordingly. Dispute among employees and partners, promoters and the employees, they have the dispute is there. Adverse changes to government policy, they are resisting the change to government policy. New technology emergence. So as I said, new technology emergence, whenever a new business is looked at, it is very important for the lender to look how the technology disruption will change the business. So new technology emergence is very important. Quantitative, external, internal. External is bureau, decline in bureau scores, path and magnitude, name appearing in the negative list, increasing in liens, out of business flag, several delinquency flag. So these are credit bureau which gives the indicator. Okay, the bureau scores which is going down. The lien means number of your FDs are getting lien mark. Out of business flag, there's no business, and similarly other things. Public sources which you get, name appearing in the MCA RBI defaulter list or willful defaulter list, failure to raise supplies on unusual credit terms, not getting good market creditworthiness, legal suits filled in courts if there's a litigation is going on, if there are any kind, because litigation will impact if there tomorrow there's a fine, there's a problem. News feed, negative internet sentiment through text data mining, negative press releases of financial or operating performance, fraud news, financial point, declining net worth or current ratio, poor cash to liability. So you have inadequate cash on books, fudging of financial, window dressing of financials, borrower reporting stretched financial, they're reporting the stretched assets, delay in submission of audited financial or stock statement. Whenever there's a delay in financial reporting, financial performance below expectation, financial performance is not as per the industry benchmark, or there's a decline in that. Internal could be trade line information, stress on the credit or trade lines, one or more repayment obligation default. There's a default in any EMI or default in any kind of loan repayment. Guarantee invocation, bank guarantee getting invoked. Key customer loss. Say a company has a main customer, large customer, 70% is dependent on that. So if that customer is lost, then entire business goes for a problem. Payment attitude behavior, delinquency increases, out of pattern behavior, high capacity utilization, increasing percentage of customers with 60 or 90 days past due, which is a problem if the due is more than 60 or 90 days. check bounces, avoiding contacts with banks. If there's avoiding the contact with the bank, there's a problem. That means he's avoiding to talk to the lenders. Increase in frequency of overdraft in business account on return of checks. Too much of increasing overdraft or asking for an extra limit is stress on the books. Frequent extension request for repayment. Internal rating dropping, credit rating. If the credit rating drop, then there's a stress. This can be a big value addition. This is happening. AI and ML make significantly powerful. So this is something we gave point by point, and this points can be more. So it's not that qualitative or quantitative in that external, internal. These are the limited points. This can be made robust with increasing number of points. These are the few of the data points we collected. So insights generated. These are the information and use. So what are the information we get? Number of new loans applied after loan approval from client. Number of new loans disbursal after loan disbursal from client, defaults after loan disbursal, credit product, negative events after loan disbursal, drop in minimum balance after loan disbursal, latest account balance, drop in monthly credit amount after loan disbursal, jump or drop in surplus after loan disbursal, all bank loan account list and balance on the same, all mobile number of user, drop in salary, insurance or SIP missed after loan disbursal, utilization of credit products, credit card, pay letter after loan disbursal. Basically, it can be, but there are 13 points here. It can be 50 points also, and there can be various usage. Now, the number of points depends on what the logic the lender want, and whatever the logic the lender will require for, it can be put in this technology. These are all use cases which is there in the industry, which has been used. This kind of information is generated, and there are various usage of that. And it can be increased the number. The more number we increase, more it becomes the robust. So predictive, what is the predictive lead scoring analysis? So first is get conversion data, collect the past data. So we're saying that you have to collect the first important thing of developing any algorithm will be the data, which is the past data, getting it. Prepare the data. Prepare the data. After getting the data, wash the data, because the data has to be formatted. There will be biasness in the data. There will be skewedness in the data, and there are various things we look at in the data: skewness, kurtosis, and various other things. We do goodness of fit, and which are the basic statistical, inferential statistical, descriptive statistics we use to wash the data and format. Before the data is put into the machine learning ML to get the algorithm, it has to be washed and formatted and get in the perfect form. Because if the data is not formatted, which is the basic or the starting of it, entire model will become wrong. Then train and test an algorithm. Basically, create an algorithm and test it. You have to see what is the accuracy giving, what is the percentage of confidence it is throwing. So that data algorithm has to be tested and trained. Then measure the effectiveness. After it's tested, then finally you can take it to the server. So how it happens that initially the fintech company who develops the algorithm, they create this algorithm with their own logic, with their own data, the data available from other sources. Then once an algorithm is developed, it is taken to a lender and used on their platform, because the lender data cannot be taken outside. So when you're making the algorithm has to be made with their own data. And when it's put on the banks or the NBFCs there on their system, then you can measure the effectiveness of the algorithm. And accordingly, the algorithm can be keep changing, because the algorithm has to pass on through more data to become more and more accurate. So that discussion will happen with the fintech and the banks or the lenders. But this is how it typically looks, that predictive lead scoring analysis, get your conversion data, prepare the data, train and test an algorithm, measure effectiveness. Early warning signals monthly report. So it's a monthly report given. It can be 15 days report also, and as I said that it's like a dashboard. When you log into the system, it will pop up and it will show the red flags. So what is there in the report? It shows risk analysis. It shows account summary. It shows the vulnerability. So risk analysis is done keeping in certain risk parameters. The risk analysis is done. Account summary is how the account behaved. Vulnerability is the business credits, personal transaction, inter-firm transaction, interest payment, and various. So which is how it is vulnerable, how the account is vulnerable. So how many business credit, has the business credit gone down? Personal transaction has increased. Inter-firm transaction has increased. Interest payment has increased. These make the account very vulnerable. Likelihood, total EMI, borrower's default, EMI bounces, penal charges, these are likelihood. So recommendation, immediate action. So what we are saying in this that these kind of, when we are preparing a typical dashboard, these are look at what is the vulnerability and the likelihood of the account to be volatile. And there's a percentage given. It's at 70%, 80%, 50%. And above a certain percentage, there's a recommendation given by the team that immediate action. Immediate action could be meet the client, immediate action could be increase the collateral or reduce the line or look at the credit limit or the discussion. This will be so the system will throw up this kind of summary, this kind of dashboard. This is what a use case is. Machine learning algorithm for a loan automation. So as I said, we'll also touch on this. This is interlinked. When we are initially taking a client request for a loan, the data, the behavioral data is taken that time. Both alternate and financial data points are taken. The algorithm is made for loan dispersal and then the early warning signal. But the source of data is taken initially. Probably with the after dispersal with time, more data is connected on EWS, but initial logic is same. So this is the machine learning for a loan automation, which is historical data flow, including characteristics and repayment account, feature selection and machine learning algorithm pool, and then whether it's not good, reject, accept, and that. So with not good, non-performing algorithm, reject, bad loans, algorithm which outperform others to make decision, and then accept and good, and characteristics, update and repayment records of new application. So this is typically a process for a loan automation, which is given at the initially. But data is collected for early warning signal and for the loan, both alternate data and behavioral data and financial data is collected in the beginning. Early warning signals. So basically, so what is early warning signals? What we spoke about is that it creates an early warning signal for various portfolio, engage with the lenders and client. And this portfolio can range from anything. It can be a personal loan, it can be auto loan, it can be a home loan, it can be a business loan, anything, any kind of loan, even in corporate or trade finance. This will help in moving from reactive to proactive collection mechanism. So from reactive means after we have an issue, from there we know that we will have an issue. So reactive to proactive. It will help in proper loan dispersal by the lender. The loan can be disbursed properly. It will help the lender to plan his loan management. It will plan how you are able to plan your loan, how you are able to plan your cash flow. It will help in that. The AI has helped in generating pre-approved products for banks and NBFCs. Now, this is again for the same or loan automation algorithm is used, where we will see nowadays pre-approved products are coming. So if you are with a bank for say a number of months, so with the basis of your account, number of credits are coming, number of debits, your CIBIL score, you start getting pre-approved products, pre-approved personal loan, pre-approved home loan, pre-approved auto loan, etc. So this is the same algorithm which helps in there. So the logics are different, but ultimately the process is same, whether you're talking about a loan automation or you're talking about an early warning signal. The algorithm can be patented. Yes, for the fintech company, if you develop, it can be patented and it can be a proprietary algorithm, which will help the company. Dependency and limitations. the user should have the client's app installed. So one of the points I mentioned about the SMS permission, so which is there. Once the app is installed, SMS permission should not be revoked. That means SMS permission should be there. SMS permission will help you to get the characteristics of the particular person. So it is very important. Customers' performance data shall be shared by the client daily. Client will share the lender has to share with the fintech company customer record. It will be batch processing, not a real time. So as of now, still it's a batch. It's still not real time. Where we are saying that we should get whenever I log into the system, it get refreshed. As these are comparison variable processed from disbursement after 5 days. So typically industry it takes that time, and it will take about 4 to 5 days after the disbursal. So there we come to the end of the early warning signals and how this thing. So what ultimately I say that we move from proactive management, from reactive management to a proactive management. We are saying we will know when the loan is going to go bad, and we know that how the portfolio will behave. The better accuracy we move to, the model becomes better and better. It depends on the model how much data is put and how much the model is going through, and more the number of months, more the number of transactions, more the data, it will become intelligent. So early warning signals is a very important thing in portfolio risk management today's context, and it is backed by total fintech. I will take a minute to talk about why learn fintech at Amity Future Academy. As I started saying, I'm a program associate with Amity Future Academy. I had been taking classes on various subjects on this. I come from a banking background. I have a 15 years banking background and with large banks. After that, currently I'm an investment banker, and I'm interested in technology, more so in the fintech side of it. I've done a lot of work on fintech, live cases, live work, and also I take classes on fintech. So Amity Future Academy, fintech is, we have a very excellent course. What are the advantages in this course? E-learning, best option current times. Today's time, e-learning is the best. You can sit at home, you can take lectures from anywhere. You are traveling, you are in a different location, you are internationally, wherever you can take. And there are recorded lectures which you can look at later on. So e-learning is the best option, not only in corporate, in across. One-on-one mentoring is done. We do a one-on-one mentoring of the student by the faculties. Well-defined curriculum that extract the maximum out of the students, limited time. This for working professionals. So the curriculum is developed in a way so that the maximum is derived and the student get the most benefit of it. It is also very industry friendly, so that if somebody wants to shift to a career in fintech, can easily do, or somebody wants to start their own fintech, can do it. This is for both employees and employers. Personal attention given to students by the faculty. As I said, since there's a one-on-one mentoring and personal attention is given by the faculty. The faculty is also engaged with the students to know their aspiration in terms of whether they want to do a startup or they want to work and where. So that help also faculty, because the faculties are experienced people from the industry. Career guidance and counseling is given, as I said, again with each of the students. They'll discuss what is their interest, and there are projects given. There are capstone projects, live projects done, which will help to build the portfolio of the student. Plethora of additional resources suggested topic-wise. There are various resources are there. Various case studies are discussed. Various international case studies are discussed, and good learning tutorials are also provided. All e-learning tutorials. International collaboration. There are various international collaborations are there, which helps in making the program strengthen to get international accreditation. A dedicated team with very quick response time and 100% problem-solving rate. So the team extremely dedicated team, extremely team is connected with the students, and each and every student get the full attention, and the response time is the turnaround time is the quickest. So these are the advantage of studying in the fintech at Amity Future Academy. And what we mentioned about early warning signal is just a 1 hour capsule here, but this is something which will take at least 3 months to understand, because there are a lot of background on this. There are a lot of data modeling, data-driven courses which will help to learn. So if somebody needs to do a deep dive in that, understand fully, one has to go through the entire course to become an expert in this. With this, I sign off. Thank you so much and have a great day.